we'll start going through the questions for this Friday, December 4th presentation. Gary asks a good question. This is related to the radioactive trading techniques. And Gary, you've probably been studying other strategies, I understand that. But Gary says, it seems the married put strategy requires a lot of maintenance. Can you elaborate? I will be more than happy to elaborate. The married put technique we're discussing, the radioactive trading techniques, of course, RadioActiveTrading.com, Ernie and Power Options here. We bought the rights to radioactive trading, I think, back in 2006 or 2007 when we partnered up with Kurt. This married put strategy is a strategy that I trade in my personal account with about 50 to 60% of my available capital. As I mentioned, I've been trading for over 12 years, and I've done covered calls. I've done credit spreads for an extended period of time, about a year and a half. I've done naked puts. I've done calendar spreads as well. I've tried to buy calls, buy puts, and do strangles. And the reason why, after the past 6 years, I'm still trading the radioactive positions with 50 to 60% of my portfolio is because I've gotten better returns long-term than any of those other strategies I've traded. Once you factor in the losses, the management, and so forth, the married put technique performs better in my portfolio. Now, let's take a look here. I'm going to go to my portfolio, and I'm just quickly going to show you the positions that I have open. No, that's not it. I haven't updated it recently. I'm sorry. You know what? Maybe I'll do it this way. Let me go ahead and I'm going to show you something else here. I'm sorry. How do I want to do this? Let me pause the screen for a second, folks. Let's do this here. My apologies. The webinar account, I haven't been updating at the same frequency that I update my normal account. So instead of being logged into the webinar account right now, I am going to go in to my personal account on Power Options. And let's go into the portfolio. My apologies, Gary. Let's get there right away. Okay. Let's see. Is that going to come up now? All right, fantastic. So this isn't too much different, but these trades you see here right now, IDTI, Seagate Tech, Texas Instruments, AGO, and Boyd Gaming, BYD, these are all actual trades in my trading account, and they are all real trades, lack of a better term. Okay, so where I wanted to go here in Power Options is I want to go to what's called the analysis view in the portfolio. And in the analysis view, you sort of see the positions that we've made. Now, I've been in AGO, Assured Guarantee, since August 11th, 2015. On that day, I bought the stock and I bought the put. Okay, so this was one transaction, the married put position. On 8/31, we rolled the put down in price for a specific reason to generate a credit. And then we also sold a September call. So that's two transactions really since the initial transaction in August. Okay, so August 11th was number one. We opened the stock and the put. Rolled down the put following the rules in the blueprint, sold a September call which expired, sold another October call, and then I rolled the put back up and sold a higher strike call as the stock continued to move up. So we've been in this position now. It's actually now, okay, we're looking at, I'm sorry, December 4th is today's date. So from August till December, 4 months essentially into the trade, almost exactly 4 months into the trade, after opening the position, I've made 1, 2, 3, 4, 5 adjustments. Okay. Now let's say that I was rolling a covered call and I opened AGO when I bought the stock originally at 26.56, and let's say we sold a 27 call. And the stock moved down, we let that expire, you know, just as this one did. That wasn't a transaction, it just expired. So this isn't even really a transaction. We sold to open the call, but it expired. We did not roll it. So in any case, if I bought the stock and sold the call, the stock moved down, that call would expire. Now that the stock was trading down at about $24 per share, I might have sold a 25 call. But then the stock would have come back up. I would have had to buy to close the call and sell another one. So we would have gone from from August to September, and then from September to October, closed that call, probably sold a November call, which would have expired worthless, and then we'd probably be holding a December call right now. So that would be initial covered call, letting it expire, and selling a new covered call, buying it back, and rolling to a higher covered call. We could call that 1, but we called my adjustment 1 here, so we'll call that 1 and 2 as well. And then selling the next call for December also. So managing a covered call as the stock goes up and down, to me, is almost the same as a married put. I understand what you're saying, Gary. We teach 12 different income methods in the blueprint. Some of the income methods are best used if the stock moves up as I expected. Some of the position income methods, I'm sorry, Gary, are used if the stock falls in price. And then some of the other positions are best used if the stock is stagnating. So although there's 12 income methods, I'm never pressured, number one, to feel that I have to do an income method. I only do an income method if it matches the rules in the blueprint. Number two, it's whenever I look to perform an income method, it's not as though I'm trying to decide between these 12 which one suits best. If the stock had moved up and I have certain goals, I know I'm probably only looking at deciding between income method number 1 or number 6. Maybe just deciding between 4 and 3, maybe looking at 5 versus 11, okay? And if I have a different expectation, I might be considering 6 versus 12, or a combination of 6 and 12, or maybe 9 as well. So let's continue on here. Let me just clear these out here. So what you're seeing in red is what I still have open. So I still have those 3 legs open. It's essentially a collar on AGO. We have 4 closed transactions over a 4-month period. Not that aggressive. Boise Cascade opened on January 13th, 2015. Closed it in July and only made 3 transactions on that position. Didn't end up in a profit, of course. Boyd Gaming right now, we've only made 1, 2, 3 transactions since September, and the other ones are still open right now. Now, Cal-Maine, there was a lot of activity, and I'll say why. Cal-Maine, there was a lot of activity because many of our Fusion subscribers, when this position was opened originally, on July 21st, wanted to know what is the main issue if you use income method number 1 right away. So we illustrated that with this position, and it worked out, unfortunately, as we expected, which means it's not a good idea. We originally sold the call when we got into the RPM at 140. We had to buy it back for 308, so we increased our risk, and we're further behind now. And then we did some other short call adjustments, but really right here was the big trick. This was an income method number 6, which is the bear call credit spread. So this was entered as a spread position. It was 1 transaction, even though it was 2 legs. And then I applied income method number 12. So on the same day, there was 2 transactions, but it was 3 individual option legs. And we just did income method number 1 a couple times here as well. We rolled the put up twice. Ignore this. This was just an incorrect dividend entry. So this is just recording the dividend as it got paid into the position as well. Okay, so in general, let me go back to just the main portfolio. Right now I have 5 positions open because Cal-Maine was closed recently. Icon was closed recently. I'm holding 5 of the married put positions in my portfolio. I opened IDTI yesterday? No, 12/2 on Wednesday. My apologies. I was going to open up Dean Foods today, but I didn't. I'm going to probably postpone that to next week, and there's another one. So I will have 7 RPMs open likely by the end of next week. And on average, for each income method, I'd say I probably only make an adjustment on an RPM once every 45 days or so, because sometimes it's not the right time to do an income method, and I'll wait. Okay. All right. So related to the married put techniques, again, we've got a second question coming in from John. John says, I'm in an RPM now. Okay, he's got the stock and the put. Can I write a covered call in this position as the stock keeps going up? Can I move the call up, out, and profitably on an unlimited basis? John, I'm going to say not necessarily. Depends on the individual stock. Okay? Now, let's say, for example, I don't have a good one here. AGO is not a good one. IDTI is one that I might have done. If you follow the rules in the blueprint, the adjustment of income method number 1 is really income method number 2. The income method number 2 is a reaction to an income method number 1 as the stock moves up. If you follow the rules in the blueprint, you should be able to do that. But you may run into a problem where you can't roll for the type of premium that you want in the same month or maybe only 60 days out in time. You may find yourself going further out in time. That's something that Ernie does, and personally he does it well. I just don't do it in my personal account. Let me see if we can find a decent example here. Let's see, Boyd Gaming is close. Yeah, let's go ahead and go to that. It's not a bad position at all. I like this position as well. It's bulletproof. It's got about a 10% gain if the stock stays around $20. And we've got a put out to March. Well, we originally sold this call for 71 cents. It's about 57 cents to buy it back now, I think 60 cents or something. If the stock goes up to 21, it's probably going to cost me $1.50 to buy to close this call, this December 20 call. So let's go ahead and add that back in. Let's say the stock moves up to about 21. It gaps up over the weekend. This is this is something I know that could happen, but I'm comfortable with the catastrophe report here. If the stock does gap up to 21 or 22, for example, I'm still in a profitable range. But let's say we simulate buying back that December 20 call. Remember, right now we're at a bulletproof 3%, and the max return is at 10.4%. All right, so by buying it back, we're going to increase the risk back up to 3%. I'm dealing with small numbers here, of course, because of it's a low-price stock. Now, the stock at 21, let's say that going out in time, the January 21 call might be priced at about what the at-the-money call is for December. You know, the 20 call here is about 65 to 75 cents. So let's say we could sell the December 21 call for 75 cents after we bought to close this for about 50 cents more than we originally collected. Now, I'm bulletproof again. I'm back in a bulletproof position. Let me clean this up here. This would just be about 50 cents. So let's put this up at $17.92 as our cost basis to factor in that buyback. And that'll give us a better risk reward. I'm still bulletproof to the tune of 0.6%. But mathematically now, having to pay 50 cents to buy back the original call I sold, and even getting the new premium of 75 cents, which more than covered that, but notice my return dropped down a little bit. Okay, even at the higher strike at $21, my return declined because we had to pay 50 cents essentially back to close the call. We did take in another 75 cents for the new call, but that's only an increase of 0.25. And at the same time, we did gain the dollar from 20 to 21, but this does lower our maximum return now because of the buyback cost. Is it still a profitable position? Yes, but the risk you run if you have a stock that just keeps moving up and moving up and moving up, is that if you're buying back the call and rolling to another one, you may see that you're still in a profit zone, but you're lowering your max profit expectation because of the buyback cost. The recent position I just opened on IDTI, one of our Fusion subscribers asked me, I don't think this is a good stock to do radioactively. It's run too far. It's got to fall. Well, let me show you what I mean by that. Take a look at the stock chart here in IDTI. Let's go to the 6-month chart. And of course, don't get me wrong. If I had seen this stock 6 months ago and bought it at 16 instead of at 28, I'd have been very happy. But this stock has had an extended good run. My response to the customer was, this has had such a long run, it's bound to turn back. Well, if it went at one point from 16 to 20, you might have thought, well, it's done and it's going to pull back. It pulled back a little. By the time at 24, you probably would have said the same thing. By the time you hit 26, you would have said the same thing. Now it's hit 28. Am I projecting that it's going to keep going up to 30, 32, 34, 36, $40 per share? No, but I still think this is a strong stock. I did my research on strong stock in the industry, in its sector, I should say. My apologies. So in this particular position, it could pull back, but that's why I have the put in place. But why I'm bringing this up is that if I had entered this position after this nice pop here at about 20 and sold the October 20 call, might have had to buy it back. So let's say we got 50 cents here after the run and maybe bought it back for 10 cents here. And we rolled to the 21 strike because it's just at around 20. We think it could go to 21. Well, at this point, we probably would have had to buy the 21 call back for probably about $1.10, $1.20. This is a plus. This is originally sold it for. This is a buyback. Okay, so we sold it maybe again for another 60 cents here and then buy it back for $1 and maybe roll to the 24 for probably to get a good premium we had to go out to December. Well, by the time we've hit here, so let's say we get another $1 even for selling the 24 at this point, but now when the stock's up in this range, we got to buy it back for $2. Okay, so we've taken in 50 cents, we took in 60 cents. These are all estimates, of course, but let's just say we took in 50, 60, and $1. So now we're up $2.10 in premium. We had to pay back the $1.10 intrinsic, the $2 likely intrinsic, and the 10 cents, though this is plus $3.20. Okay, so premium-wise, we're losing. We're paying back more than we're collecting in. However, we are trying to get a higher strike of assignment. At this time, following this stock as a covered call, I'm probably out to January right now, or I might be at December. I probably would have sold the 28 for December at this point, and then looking to buy it back now or just hovering, but I might be as far out as into January 29 or maybe even the January 30. So did my stock gain from $20 when we would have got in maybe to $28? Yeah, we would have had an 8-point gain. We've taken off about $1.40, $1.50, maybe even more at this time in premiums. We're not positive premiums, essentially. We're negative out of our account, so we're really only realizing a $6.50 gain for the covered call. Is it still a profit? Yes. Would we have had more profit if we bought the stock with a married put and just let it run? Probably, okay? But it all depends on the premium and the buyback cost. In relation to what you're talking about with the RPM and writing a call as it keeps going up, can you keep doing it profitably? I would really look into the other income methods. Income method number 6, which leaves the upside open, and income method number 4, yeah, it pays a debit, but it's going to give you better risk-reward profile than selling a call against it, and you leave the upside open. So if you do have a stock that keeps going, that's what you want to look for. All right, Kent wants to know, when considering a married put, do you consider the day's volatility? Not at all, Kent. I'm not trying to be vague there, and I'm not going to sugarcoat the answer. But in general, when I open the married put screen, I'm looking for the positions that match my criteria, whether it's the default radioactive search or one of my own personal searches. I'm looking for something that matches my criteria at that instant as far as the stock fundamentals, the stock technicals, the at-risk threshold, and that's the same with any other position, okay? Am I concerned that over the weekend there may be another event? There might be another tragic mass shooting. There might be something that affects the market where we come out on Monday and at 9:35 a.m. we see the markets, the broad-based indexes are down 1.5% to 2%, and your stocks are down 4 or 5%. Am I concerned about that? Well, of course, we don't want to see that happen. But if it does, I know that I've got the risk in place. When opening a married put, Kent, what's more important to me is the at-risk amount, the at-risk percentage, of course the underlying stock price because I know my account size and what I can afford to trade as well. But in relation to what is the VIX at right now, what is the overall fear or sentiment of the market, I'm not concerned about that because I know that I have my protection in place where I want it. I know exactly what my max risk is. I'm entering a stock that I feel bullish, that I have the expectation may have the potential to grow 5 to 8% in the next 30 to 60 days. And that's what I'm looking for. If there's all the rumors now about, not rumors I should say, but everything coming out now about the increase in the rates and everything along those lines, is it priced into the market already? Is it not priced into the market? Is everyone going to overreact and the market's going to fall 1 or 2% the first 2 or 3 days after they do increase the rates, for example? That's a potential. Am I concerned about it? No, because I know exactly where I stand with the married put position. So I don't pay attention to that. I do want to find stocks that have some movement, meaning one of our default criteria is we're looking for historical volatility of at least 25%. I don't want to be in a stock that just stagnates with the married put position. I want to find something that has movement. Even if it has downward movement and fluctuates up and down, that's still a good opportunity to apply some different adjustments as well. Okay, Raza wants to know, directly related to the Power Options tools, how do I create a list of companies to compare them with my options criteria to select the best one? Very simple. Raza, I don't know what strategies you're trading, but let's just say you're looking into covered calls. You've got a list there. It's be the same process in any strategy. I could do with married puts right now, but we're going to go into the covered call search. When you're in any search to create your personal list, simply scroll down below the listed trades into the parameter field. This is where you can set your various options, stock technicals, or stock fundamentals. We can navigate now to the lists field. The list field in the search will allow you to include or exclude a specific sector or industry from your searches, or include a stock list. And we have some things programmed in here, such as IBD 50, the Standard & Poor's 100, Standard & Poor's 5-star group, NASDAQ 100, ETFs, and so forth. To create a list, Raza, just simply click the button here that says Create/Modify Stock Lists. This is going to take us to a page where we can evaluate our current lists. Delete something we did in a webinar, just delete Don's list there. You can create your own personal list. Notice I've created one called ETFs to remove. I've got 187 symbols in there, mostly leveraged and inverse ETFs. But just click on Create List, the text link up here, and now you can just call your list names, and we could call it just RASA stocks. And then you can paste your symbols from a list, or you can just type in IBM, KRFT, ICON. These are not recommendations or suggestions, just ones that are popping in off the top of my head from previous trades or things that I've done. So on and so forth. So create your own personal stock list. So I've got the secondary Kraft, Icon, Cal-Maine, Apple, IBM. I'll just go ahead and click Create. Oh, it's KFRT, isn't it? No, that's okay. So that new one, we just have 4 stocks. All right, so now that I've created it, let me close the window. It's going to refresh the page for me. And what I want to do now is create a search, and I just want to see, expiring next week, next Friday, what are the covered call opportunities that are going to offer at least a 2% return if I'm assigned, with at least a 2% downside protection on those 4 stocks. Let's do 1 and 1. All right, so let me clear the filters, set my option expiration time frame to all months. I'm going to put in my days to expiration, let's say 2 to 10, looking for weekly options. Downside protection, minimum 1%. Percent if assigned, minimum of 1%. I'm not going to worry about anything else right now. Now, Raza, I'll go to Lists. In the Include from the Stock List field, click the drop-down menu, Raza Stocks, and submit the search. Let's go to 0.5. I picked some very low volatility stocks, I know. I expected Cal-Maine to be up there, but oh well, let's lower our expectations. There we go. So the Apple 119 call for next week, 1%. Oh, it's even at 1%. That's why it didn't appear. There's also the 118 call and the 120 call, and IBM is giving us a 140 and a 141, which give us a 1% downside protection and at least a 0.5% return for next week as well. Then at any time, you can go in and make any adjustments to that list. So we can go back into lists, create modify stock lists, and then we've got the lists here. I just click on edit, and then we can make any changes to the different ones. We could choose to remove any of the symbols, remove all the symbols, or just add new stocks in as we go. If you create new lists or new lists appear, you can keep editing that as you move forward. So that's how we would go ahead and handle that, Raza, as far as creating the stock lists and searching against them. Once you create the stock list, the best thing to do is to go ahead and take that off as well. All right, so let me go ahead down here. I got a lot of questions in there. Oh, Jim says, can you import a CSV list? Yes. Well, not import, but you could copy it and paste it as well, and you'd be perfectly fine doing that as well. All right, so unfortunately, Michael asked a question. He was a little bit lost, didn't know what was going on there with some of our discussions. Okay. Omesh asks, how do you decide to pick a long put? To pick the long put for the married put? Well, I follow the rules in the blueprint, okay? And going back to the married put technique, the default criteria that we use to search the radioactive trades are shown here on Power Options. Now, I make some adjustments. For example, I never go higher than a 7.5% at risk on my RPMs in general. And, I try not to go more than 15% in the money. But the technique is, as I said, we're going in the money, and I'm looking for a risk that matches my threshold, and I always want to be at least 150 days out in time. That's the default criteria shown as what's discussed in the blueprint. In addition to that, I'm going to make another change in my search because I know my account size. I don't know everyone else's, but I'm going to go ahead and just change this from $5 to $75 per share. All right, so there's the 10 or so trades that match my criteria that I would enter as a married put. I won't enter Delta right now because Ernie's in it. IDTI I entered the other day. Bank of the Ozarks, Ernie is in. I'm in Texas Instruments right now. Dean Foods is one that I was considering. One of my radioactive trading customers called me up today. He actually has a reverse sentiment on that and was looking on how to play this bearishly, how he could play the limited risk techniques bearishly. That's what he wanted to do on Dean Foods. Valero is an interesting one. I don't know if I want to get into oil right now. And then, of course, we've got QHO, Western Alliance, and TAL. So to answer your question better, Romesh, now that I have these results here, which one am I going to pick? And this is actually an interesting example because on Dean Foods earlier today, let me go to the profit and loss chart. Earlier today, when the customer, as mentioned, had called me up, what was shown was actually the January 2017 22 or 21 strike put, which had a risk of 8.7%. And he asked me a similar question: how do I know which one to choose? Well, what I did is I went to the search by symbol tool on Power Options as we were on the phone. And remember, I'm just going to switch to January now. And he said, okay, the one that came up, there it is the January 20th. That was the one that came up earlier today in the search. January 20th. I'm sorry, no, it was the 22. January 22 strike, my apologies, with a risk of about 8 or 8.1%. He wanted to have a risk under 7%, so he was thinking about going to the 25 strike, which to me is too deep in the money. It's against the rules in the blueprint. So what we did is I said, let's take a look at some of the other selections, and we went to June. And, you know, based on the expectation, if my expectation is that the stock might have the potential to gain, let's say, 4 to 8% in the next 30 to 60 days, if I was comfortable with taking the 8% risk, oh, it didn't change, sorry folks, hold on 1 second, let's get that there we go. If I was comfortable going out to January and taking 8% risk, I'm probably comfortable with the lower strike here with a 6.9% risk. No, it's not as far out in time. It's 196 days versus 413. But if I'm expecting a movement in the stock within the next 30 to 60 days, this is also within the rules of the blueprint, and this might be the one I would select. June 21 at 5.5% also looked pretty attractive to me as well. So, you know, following the discussion you see in the free webinars on Tuesday and Thursday, what Kurt and we discuss in the blueprint, this is the default criteria that we use, but you want to make changes to it, the risk threshold, and what you can afford as far as stock prices for your account, and based on your risk tolerance. Is a 21 strike okay at 5.5% for June on Dean Foods? Absolutely. But depending on what my risk tolerance is and what I'm looking to accomplish, taking a slightly higher risk to be closer to at the money, if the stock now moves up to 1920 or 1950, that'd be a good time to apply some of the income methods. If I have the 22 put, probably have to wait for the stock to move up to maybe $21 or $21.50 per share before it makes sense to do one of the income methods. So it's a balance, and that's what's talked about in the blueprint of what is your risk threshold, okay? Cirrus asks, do you explain today only strategies or also how to use the platform? Both. Whatever your questions are about the platform, about the strategies, about anything, go ahead and send those in. I'm talking about strategies right now, but I'm showing how to use the tools at the same time. And if you have a specific question about setting up the strategy, I'll be able to use that for you as well. Okay, so let me get this out of the way here. A couple other questions that came in. There we go. Oh, fantastic. Glenn, if you sell a bear call spread during dividend payout, do you lose the dividend or have to pay it? No, Glenn. No, but if. No, but, Glenn. Here's the deal. If I'm in a bear call credit spread, I don't have it up here now. Let me just go to custom spreads and we'll create a bear call on Apple, for example. Let's just go out a couple weeks, January 15th. And what were we at? 119 today. So let's say we did the 120 and 125. All right, sort of an at the money, but we'll take the bear call. All right, so the question is, if I'm in this bear call, the short call, the call that I've sold, if I get assigned early, if the stock moves up above 121 and I get assigned and I don't own the stock, I'm going to end up being short shares of stock. Okay, so I'm going to essentially borrow shares of stock at 120, or I'm going to have to buy it at the market price to deliver the obligation, depending on how your broker handles it. Okay, so, but let's go this way. The obligation of the short call, if you don't own stock, if the stock moves above it and you are assigned, you will be short shares. Okay, now, as the dividend approaches, here comes the trick. As the dividend approaches, if you're just in the bear call and the stock is below your call strike price, will you have to pay the dividend? No. only investors who are short shares of stock on the ex-dividend date have to pay the dividend. Straight option players, whether you're long a put, which might make you short stock as well, or short a call, which might leave you in a short stock position depending on the assignment with your broker, you do not have to pay a dividend. Okay, because if that would imply that the person who bought the call would get the dividend, in which case no one would trade dividend-paying stocks. Everyone would just be buying the options to get the dividend to put in less money, probably. Other things, of course, relate to that, but that's kind of the rule there. So remember, if you're short stock, you have to pay the dividend. Now, one of the tricks, Glenn, with a covered call investor who's trading dividend-paying stocks is that as we approach the ex-dividend date, let's say today was the ex-dividend date for Apple, and instead of the 120 call, we had sold the 119. And even for December expiration, 2 weeks, 3 weeks away. If I had sold the 119 call and today was the ex-dividend date and the stock had moved above 119, you know what? I'm going to be forced to buy shares of stock. Okay, I'm sorry, someone's going to assign me early on the covered call. I'm sorry, I didn't say that right. If I'm in the covered call at 119 and I'm right at or slightly in the money on the ex-dividend date, I'm most likely going to get assigned early. Reason why is because the investor who owns the call wants to take advantage of the dividend. It doesn't hurt them much to exercise the call at that time, force me to sell out my shares, and they get the dividend. But the person on the other side and the market maker who has all of the short call contracts in a pool does not know whether your short call is part of a credit spread, a covered call, a calendar spread. He's just pulling and assigning long options that are getting exercised out of the short call pool. So is it possible that if I had been in a bear call today on Apple with the 119 strike and the 118, or I'm sorry, the 119 and let's say the 122 strike, and the stock today was at 119 and it was ex-dividend date, I could have been assigned at this time because the person would have wanted to own it. Now, if I was assigned and I was short stock, that would imply that now I would have to pay the dividend. Okay, so if you get assigned early on your bear call because your short call is right at the money, close to the price or slightly in the money, and you get assigned early, you may have to pay the dividend as well. Okay, Christy asked a question earlier, I'm sorry, about the married put. How do you decide a strike price? So I kind of reviewed that. It's that target range I'm looking for in the risk. So we talked about the 7-8% and so forth. Okay. And I'll get to that there. Okay, Omesh says thanks. Okay, and got 6 more questions here. So Don, I just saw your question at the end, but we're going to go backwards here. Jim asks, if you want to take a profit with a married put, do we sell the put at the same time to use it? Want to take a profit on a married put, do we sell the put at the same time, use it to open a calendar or vertical spread? No, Jim, you don't do that. If you've reached your goals in the married put, I just liquidate the position. I sell to close the stock and sell to close the put. If I wanted to continue the position, if my goals have been met on the married put and I wanted to continue the position, but I thought the stock was going to pull back, that it was going to fall, I may just sell to close the stock and leave the put open. And if the stock falls as I expect, later on sell to close the put. But I'm not going to convolute it by trying to add it to a calendar spread or make another long-winded position. Why complicate it? Keep it simple, okay? If the stock has moved up, I've hit my goals, and I think the stock's going to continue to go up, I probably wouldn't be exiting the married put position. I'd stay in it. Stock has moved up. I've met my goals to liquidate the RPM, but I think the stock's going to stagnate. Yeah, I'm going to liquidate the RPM, take my profit, and just look for a new position that's showing better growth. Simple as that, okay? That's how I approach it. If I open a calendar spread, it's because I have a completely different expectation of the stock. I'm not trying to switch a married put over into the, I apologize, I'm not going to try to switch the married put over to a vertical spread or a calendar spread to create a whole different trade off of it. If I'm opening a calendar spread or a vertical spread, it has to match my other criteria, not trying to simply keep adjusting a position from scratch. Okay, I don't know. That's the best way I can answer that, Jim. So no, when I've met my goals on a married put, sell to close the stock, sell to close the put, I'm done. I'll go look for another position. Okay, if I haven't met my goals, I'll keep trading the position. Omesh asks another good question. We do this for most strategies. In fact, I'll show you all where to see that later on. Do you use Greeks for the married put? Yes, but I never filter by them and I never pay attention to them. Let me show you what I mean. Let's go back. Oh, did I leave that open? Let's see here. Go back. I'm trying to say, okay, I didn't do that. Custom spread. Okay, let's go back to the married put search as I mentioned before. So we open the search, and I'm going to customize this again for my basic criteria. Once again, I'm going to put my risk on the married put to be between 3 and 7.5%. I'm going to lower this down to 15 for the range in the money, personal preference. And the fundamentals I'm going to keep with a stock at 5 to 75. I'm going to change this also for some of the other things I look for. I typically like to only look for stocks that have shown maybe 5% earnings per share growth from last year to this year. And I'm going to up my average stock volume to 750,000 shares. Now, right now, I'm only scanning against the IBD 50 and CanSlim list. Let's run that search again. And I've narrowed it down to 5 trades. Okay. Now, I didn't screen by delta. I did not screen by gamma, theta, or vega. But I want you to notice something right here. These 5 positions, I have the delta column selected. My range in delta is from negative 0.52 to negative 0.55. That is a very restricted delta range, but I'm not using delta. Okay, how about gamma, theta, vega? Okay, well, if I go in and choose columns, even implied volatility, if I go in and choose columns here, oops, sorry folks, it's kind of jumped on us. I'll select gamma, theta, vega, and rho. In addition to that, I'll also select the implied volatility. Okay, and let me save that and close the window. Okay, all right, so my deltas are all the same. My implied volatilities are within a tight range, no greater than 0.419 and no less than 1234. That's kind of funny. Gammas, 0.02 to 0.05, pretty restrictive. Theta, vega, all within a tight range, but I'm not filtering by them. So how is that happening? If you set up a reasonable search in any strategy, for example, if I look for covered calls and I look for quality stocks that have good fundamentals and good technicals, a reasonable return, what do I mean by reasonable? You know, I'm not looking for a percent if assigned of 10% with a downside protection of 20%. That would imply too much implied volatility, okay? I don't want that. But when you create a reasonable search for the strategy that you're doing, you'll find that you're already screening by the Greeks without screening for them. And this is the subject of one of the archive webinars. And if you want to get deeper into it, you go to the webinars page. It's just powerop.com/webinars.asp. I'll send that link to everyone in the chat. Okay, so in the chat box there. It's a public page. You don't need to be logged in. And if we go into options concepts, there's one here, Greeks and why you may not need them. Greeks are not necessary for strategies, in my opinion, and in my practice. The Greek terminology and the Greek discussion is not necessary for things such as covered calls, naked puts, married puts, collar trades. We could argue even that it's irrelevant, well not irrelevant, but it's not very useful for bull put credits, bear call credits, or even iron condors, okay? It's not maybe something you necessarily need to focus or confuse yourself with. The Greeks really come into play when you're trying to do neutral strategies. What I mean by that is the ones that are specifically related to Greeks. Delta neutral, gamma hedge, things of that nature. That's when you really have to pay attention to them. I would pay attention to them with things such as naked calls, okay, or other strategies like that that take on high infinite risk. And calendar spreads. I use the Greeks, delta and gamma mainly when I do calendar calls and calendar puts. But for other strategies, it's not necessary. And you'll see why in that webinar why we say that. Because if you create a reasonable search for stocks that would match a neutral to bullish, safer, neutral to bearish strategy with reasonable fundamentals and technicals and a reasonable return, you're already filtering by the Greeks by not filtering them. Okay. Raza says, if I have a portfolio of naked puts, how can I buy insurance for the entire portfolio? My trades could be in different exchanges. Yeah, there's a presentation that we did also. I don't know if you've seen that in here. I think it's in Options Concepts. Yeah, stock or portfolio insurance. Okay, so this discusses maybe buying puts on the ETFs or broad-based indexes, maybe using VIX calls, volatility index calls, to hedge against a black swan event. It can be more expensive. And it does get tricky when you're spread across different exchanges, different sectors and industries. Okay, what you probably want to do is find out what percentage of your portfolio is allocated to each potential sector or industry, or how much of your naked put portfolio is more closely related to Standard & Poor's S&P 500 stocks versus NASDAQ 100, or maybe the Russell 2000, IWM. And then you can evaluate what portion of your portfolio you want to allocate to puts there. This does become tricky though, okay? And they're part of this presentation. I think it's in this discussion. It might be in a different one. Let me take a look here. What's known managing, okay. Let's see. Where I was going to go with that, Raza, is that we did a presentation a while back, I think it was during one of the open discussions, where a customer was heavy into Standard & Poor's covered calls and naked put positions, wanted to protect the entire portfolio. So we sort of showed a breakdown of, maybe buying puts or doing this, but we went back in time and evaluated the portfolio about 2 months back. And part of the problem was the customer was heavy into GE stock. That represented most of his portfolio. And he bought puts on the S&P 500. It was on the ETF, I'm sorry, so it was on SPY, it wasn't on SPX. Over a 2-month period, GE dropped by about 12 or 14%. I can't remember the exact number. And it was taking out a large portion of his portfolio. The problem was that during that time frame, the rest of the S&P was actually moving up. So he was losing money on the insurance to buy the protective puts because the S&P 500 was moving up at a good pace, about 6 or 7%. GE was down 12%, so he was losing on the larger portion of his GE stock and losing on the puts that he bought for insurance. It wasn't helping him hedge the position. That's some of the danger of trying to insure an entire portfolio, is that if you're heavy into 1 or 2 stocks and that stock collapses against you, but the rest of that sector industry is still bullish or it's still neutral to bullish, you're going to lose money on your insurance and on the investment as well. If you do find something that represents a larger portion of your portfolio, maybe 12% or 15% of your portfolio because of the number of contracts you sold against it, I would consider that insuring that position 1-to-1 by buying a put option to create a calendar spread or standard spread, or mimic an RPM position, because if that falls 10, 15, or 20%, you now have direct insurance against it, okay? But yeah, back in that webinars page, again, under the option concepts, check out the video on stock or portfolio insurance, and then send me an email next week or give me a call if you have any questions. All right, sorry folks, Harvey wanted to know, good strategy to buy put on oil stock after buying the stock with an 11% yield. If you mean a dividend, Harvey, I have a hard problem with that. Ernie showed an example of this a couple years ago. A lot of investors came in and said, okay, if you're in a married put that has an 8% or 9% risk, why wouldn't you just set that up with a high dividend paying stock that pays a 12 or 13% risk and you're instantly bulletproof? Because it doesn't work that way. Because the rest of the market knows that that stock pays a 12%, 15% dividend. So that means it's already priced into the put options. Ernie got into Annaly Mortgage. I don't remember the exact prices. I think it was around $14 for the stock, and he bought a 16-strike put a year and 2 months out in time. And he had a risk of 12.8% on the married put, and the stock paid a dividend at the time of 13% of the $14.50 or $15 per share that it was. Over the course of the next 12 months, Ernie was only available to perform 1 or 2 income methods, because with a stock with that high of a dividend, there's no premium to sell a call. The at-the-money call, even 2 months out in time, is only 20 or 30 cents. Well, it's 20 or 30 cents that you didn't have before, but it's still a little tricky. So married puts on the high dividend-paying stocks, let's just look at some of these here. We found that it doesn't work out. Okay, even if you think you're bulletproof, your expectation to get any profit above the difference between your at-risk and the dividend yield is very, very small. Okay, so let me do this again. I'm just going to put some basic criteria in here. Give my max risk under 20%. And I'm not going to go more than 15% in the money. And it doesn't matter about the stocks. What does matter is let's look for a greater than 10% yield. And let's keep the list simple. 1 result per security. Okay. All right, so we've got a couple of these energy partners, NGL, dividends. Okay, let's clear this up. So I can go back and choose more columns now. I'm going to remove some of that unnecessary information that we used before. I don't want to see delta, IV, gamma, theta, vega, or rho. What I do want to see is my percent dividend yield on the stock as well. All right, let's go ahead and do that. All right, and let's ignore the earnings date there. And yeah, see, here's the problem. If I showed you a regular married put screen where I was buying stock at 1483 and I was buying 168 days out, 15 strike put, you'd expect to see a risk of 6 or 7%. Here the at-risk is 18.2%. The dividend's only 11.3. Now, let's go forward. NLG Energy Partners, 1354. The July 15 strike put, 224 days away, 16.9%, but we've got a dividend of 17.9%. Am I bulletproof? No. Because remember, this ends in June. I'm not in it for the full 360 days, so I'm probably going to miss 2 dividend payments and not get that. But let's take a look at the profit and loss chart. We're not going to get all the dividend, I should say. Let's take a look at the profit and loss chart for NGL and clear up our drawings here. There we go. So it's a high risk position at 16%. We know we're going to hedge a lot of that because it's a high dividend payment. But just looking at the chart for the last year, and I've never seen this stock before, number one, this is not something of course the energy is taking a hit. This is not something I'd want to trade as a married put. It doesn't give me any confidence for a rebound. I shouldn't expect energy to come back up just because this dropped from 30 down to 15 in the last 6 months doesn't mean it's going to go from 15 to 30 in the next 6 months. Okay, so that's probably not something I'd look for. Let's change this a little bit. I'm going to go into the technicals. I'm going to look for a stock that's trading in an uptrend. Okay, so it's above the 50-day moving average. That takes us down to 20 results. Oh, here's one. It's 224 days out, but Hercules Tech, $11.77 for the stock. 12.5 put would give us a risk of 8.9%, and it pays a 10.8% dividend. Well, if I stayed in it for 360 days, well, I've got to find a put that's further out in time, but then my risk is probably going to go up equal to what the dividend is. Long story short, here's the trick. Unless you think that this stock has good growth potential, that it might grow 10, 15% over the next 8 to 12 months, this isn't a good candidate for a married put. If the stock stays right around where it is at this 1177, sure, you'll collect the dividend, but all that is going to do is counter the extra premium that was priced in because the entire market knows that this stock pays a 10, 12, 15% dividend. And see, this one here is not bad, but you know, it's come down to 10, come back up to about 12, come to 11. In the past 6 months, it's been in that range, and just like the other one we saw, it's been up before, but now it's down in this range here. So we don't recommend doing it. In fact, if you're using a dividend-paying stock for a married put, Ernie and I suggest that you don't go above a 5 or 6% dividend yield. Will you collect the dividend and make a reasonable return, a reasonable dividend yield? Absolutely. You have a very strong dividend yield. The trade-off is that it's priced in, so your expectation for profit above the difference between your at-risk and the dividend is very small. All right, so Don says, going back to this other question, all right there, Jim made a reference that when he's buying options, long options, he uses a delta of 0.65 to 0.75, and that's fine if it matches your criteria and your technique. Okay, all right, Don's question, I'm sorry. In a married put, can you use a long call well out in time rather than buying the stocks? No, Don, we do not advocate doing that, okay? The long call, let's go back to the main screen here. The comparison of the long call to the married put, we're not arguing that they don't have a similar risk-reward profile. They do. The reason why we do not, I'll use IGTI right now, because that's the married put I just got into recently. All right, so let's go to the profit and loss chart. If I open the married put on this position, I want to check something here. There we go. Oh, it's not that bad anymore. $3.70 to $4. Could have gone in at $3.85. Okay, so we're going to use midpoint here. We're going to call this $3.85. If I get into IDTI right now and I bought the May 30 put at $3.85, I'd have a risk of $2.64 or 8.1% on the position. Let's say I have a $100,000 account, Don. I'll try to draw this up here. Oops. Let's say that we have a $100,000 account, and right now we've got some other trades in there. And with this investment of 3264, let's say that we have $10,000 of free capital, 10% of our portfolio in free capital to make a trade. So if I was going to open this position, that would dictate that I'd open 300 shares of stock and 3 puts. That would put my cost basis at about $9,728, okay, $9,728. But my risk is 264. So that would put me at, let's see here, 750 plus about 32. So it'd be $728 would be my maximum risk. Okay, so that represents less than 1% of my total portfolio value. That's the total monetary risk. I've invested $9,728, I'm risking $728. So it's less than 1% of my total portfolio, and this amount only represents 8% of what I invested into the entire position. Now at the same time, you saw me open this married put in the Fusion portfolio, and you decided that you're going to do the same thing, but you're going to buy the May 30 call. Not bad. Bid of 260, ask of 275. Okay, and you have the similar account size, $100,000 account total. You've got $10,000 of free capital to invest. Okay, so you say, all right, well, I'm going to buy it at 275 there. Nope, sorry, I got to do something. My apologies. Let's add that back in. Okay, so it's 275. Was that my midpoint? Oh, I'm sorry, folks. No, midpoint 265. Let's call it 267. Okay. All right. So buy one at 267. Okay, so it's monetarily very close to the at-risk amount. And if I did 3 contracts, it'd come out to about 720, 731. Okay. All right. So we can go ahead and submit that. Now you have a similar risk-reward profile, but you're risking 100%. Again, you have a $100,000 account. No, this is an exaggeration. You might even have more, but I don't have a $100,000 total portfolio. You have $10,000 free capital to invest. You saw that I opened 300 shares and 3 puts. You say you're going to buy 3 calls, and that's going to put you up at a slightly higher cost basis, about $731. Okay, now you're risking 100% of your trade, but you kept it to 3 contracts, so our monetary risk is about the same, 731 to 728. We're both less than 1% of our total portfolio value. Now, here is where the trick comes in. We don't advocate this not because the risk-reward profile is so different. We're not even saying that. What we're saying is that this does not force you into an ideal size trade. All right? And what we mean by that is that I took my $10,000 of free capital, invested almost all of it, but I'm only risking 8% of that, or less than 1% of my whole portfolio value. If there's a black swan event or the entire market's dropped 15 to 20% in the next 3 months, I can only stand to lose $728 of this $9,700 I invested. And you say, okay, well, you're only risking $731. There is no difference. Well, the difference is after you make this trade, you now have $669 of free capital. Are you going to leave that alone in your account? No. You're going to buy 10 calls of stock ABC. You're going to buy 5 calls of stock XYZ. You might even buy 3 puts on some other ETF, 1, 2, 3, for example. You're going to invest more of this capital. And the minute you start doing that, we are no longer at any type of parity because you're risking more of this full $10,000, 10% of your $100,000 portfolio, and I'm only risking less than 1%, even if the market drops down 20% over the weekend. Some of the other reasons why we don't do it, which is discussed in the blueprint, you can also see more about this, Don, if you go to RadioActiveTrading.com. Let me clear up the drawings there. And if you go into the blog, we could run a basic search. We could run a basic search on the blog for long calls, if I can spell, versus married puts. I think this works. Okay, and you'll see a lot of discussions here that Kurt has put forward, long calls versus married puts. What is the difference between them? Why we don't advocate doing them? It comes down to discipline. It comes down to the risk. In addition to that, it also comes down to there are some adjustments that we can make on the radioactive position, manipulating the time value shift on the put options that doesn't work as well with the long call. So you have to decide if that risk is right for you, if you're going to be disciplined, if you're not going to overtrade, because the minute you overtrade is usually when our investors get into trouble. So they think the long call is the same as a married put. They see me put in, let's say, $6,000 into a position. They end up buying $4,000 worth of the calls and say that, oh, I'm still risking less than you. Well, no. I'm only risking 5% of the $6,000 I invested. You're risking 100% into the calls that you invested. Glenn asks, how do you search for neutral stocks that are not trending? What would be, let's go to, I don't have Iron Condor selected, but let's go ahead and look for neutral stocks on a naked put trade. I'm going to go into the search. Of course, all the fields are the same, technical, Glenn, and fundamentals, but let me clear out the filters here. I'm going to just look for basic naked put technique. Let's go out 10 to 20 days out in time, roughly, so about 2 weeks out in time. Let's call it 10 to 25. I'm going to want a minimum naked yield of 1%. Let's say just 0% out of the money, just to keep the results simple. Now, there's a couple ways I might go about this. The main way that I'm going to use is the Bollinger Bands and the Bollinger Band range. The percent BB20 shows me where the stock is trading right now in relation to the upper and lower Bollinger Band. Give you a better example of that. Let's go to 5 below very quickly. I'm going to go to big charts. I'm going to customize this chart more along the lines of what I look at. So let's go set it to 6 month. I'm going to put the 20-day moving average in here because that's related to the Bollinger Bands. I'll show why in a minute. I'm going to select Bollinger Bands, and I'll just put in MACD and RSI in here as well. We'll just kind of use that. All right. So let's go to a 3-month chart. It'll be easier to see. Okay. So for a neutral trending stock, I guess what we'd be looking for here is something Glenn might have been interested in, is just in this time frame here. And there's nothing wrong with that at all. It's a good trending time frame. What are the factors that we see with the Bollinger Bands? Number one, the Bollinger Bands here are an envelope around the stock based on the 20-day movement. This is the upper Bollinger Band. This, of course, is the lower Bollinger Band. The percent BB20 that we saw in power options is showing us where is the stock in relation to the Bollinger Band. Meaning that if my stock is trading up here, if the stock's been moving up like we saw with IDTI, the Bollinger Band would be here and the stock would keep moving up and the Bollinger Band would keep going. So we'd be up near the 90 or 100 percentile of the percent BB20, sort of where we are here. A stock that's fallen in price might have dropped below its lower Bollinger Band, as we see 5 below here. This is the lower band. So a percent BB20 of 0 or less than 0 is if the stock is below the lower band. When I'm looking for a neutral or trending stock, what I'm looking for is not only a stock that is around this range. Now see here, this one's fluctuating because it's up near the upper 100% of the Bollinger Band here. It's at 50% here. It's negative here. But the bandwidth, whenever you have a constriction, the percent bandwidth gets really tight. So here's what I'm going to do. I'm going to go back to our search. And in the technicals, I'm going to look for a bandwidth that's on the lower range. Let's try less than 15%. Now, I'm not going to use the percent BB20 right now, but I may restrict that later so it's not above 100 or below. A good range to use might be, let's say, between 30 and 70 to start with. Okay. Micron, that's interesting. That's had a drop recently, but let's check it. Oh, I'm sorry, I forgot to save the setting, so I have to reset that again for the Bollinger Band range. We'll go 3 months again. Of course, you could extend it out to 6 months if you wanted to when you're looking at the chart glimmer. I'm going to put this back to SMA 20, and I'll just use Bollinger Bands for now because we're just focusing on that the most. There we go. All right. So this looks like it's been all over, but it has really been between a range over the last month or two. We could say 19 to 14. That is kind of large for a low price stock, but it's condensed recently. And notice how the Bollinger Bands are getting tighter and tighter together. Is that indicative of a breakout? Maybe, maybe not. Let's look at Zillow. I haven't looked at them in a while, and I didn't know they split off to Zillow and Zillow Group. Oh, sorry, let me do this, though. This will save us some time. Let me go ahead and store those chart settings for us. Fantastic. All right, back one more. Let's look at Zillow. Still a wider range than I'd like, but you see over the last 10 to 15 days it's been condensing and the Bollinger Bands have been getting closer after that recent decline. So that'll give you a starting point there, Glenn, I'm sorry. I would use the Bollinger Bands. You can also sort of use the MACD, but I choose not to because this is more looking for a breakout that's been over or under a cross signal. So I'll use this, and you could also restrict it. Anything that has been channeling is probably going to have a volatility on the stock of less than 0.25, maybe less than 0.2. Probably see the same ones here. Oracle, Red Hat. Let's take a look at Red Hat. I haven't seen them in a while. Okay, so they have a low volatility, but they have been moving up consistently. Okay, so they've just settled down between 82 and 82 over the last 30 days, but they've been moving up. But you see that the Bollinger Band range is getting closer and closer together here. It's tightening up there. So that's how I would use that. I would use the Bollinger Bands, and there's an article there as well. Okay. I don't know. Jim here said that Line and CHK stopped paying dividends. Okay. Let me take a. I guess that was from the married put search we did before, where they showed up as well with a dividend. So we'll have to see if that adjusted. All right, John. At my company, I can buy stock quarterly at a 15% discount to the market time. How should I structure the position? I'd personally go into married put, and I'd go into the insurance tool. This allows me to put in my stock symbol. Let's say I was in IDTI, that I was worked for IDTI, and I was able to buy stock quarterly at a discount there. The stock, I'm sorry, was trading at $28.50 today. So if I'm able to consistently get in at a 15% discount, that'd be $4 off, $4.27 off. So let's call it $24.25. So let's say I can pick up 100 shares today at $24.25 with my 15% discount. And where did we go? No, IDTI was May. Let me just go to May real quick. All right, so, oh, okay, it's a little bit too high. Let's put in $24.75. Okay, it's probably 25, but look, here's my 15% discount close to it. But this is a different field. It's showing me that right now, that same 30 put I bought yesterday on the stock, which put me at a risk at 8%, if I own the stock and I bought the May 30 put today with a 15% discount on the stock, I'd have a locked-in profit of 4.3%. What does that mean? It means that I'm bulletproof, that I cannot lose on the position. I got a 15% discount. I picked up a put. It's about 169 days out in time. My total investment into the position is only $28.75, but we're guaranteed to get 30 back. So I'm bulletproof on the position. And I can treat this as a married put that's bulletproof from the beginning. Okay, so this gives me more freedom actually to apply income methods right off the bat whenever I want to increase this bulletproof status and earn extra return. Now you'd say, oh, well, I have a 15% gain right now. Why would I pay the $4 back into the position? Remember, you didn't lose, if you said, okay, well, you have a 15% discount, so you have an unrealized 15% gain. Why would I take that unrealized gain and shorten it to only a gain of 4.3%? Well, that's not what you're doing. That's the worst case scenario if you hold the position all the way to May and make no adjustments. Right now, you could turn around. If you bought this put today for $4, or tomorrow or Monday for $4, let's say, on the stock, you could turn around 10 minutes later and sell it for $3.90. All you're giving up is the bid-ask spread. You're not down 12%. You didn't give up this 11% gain. That's just the worst case scenario. You still have money in the put, and you still have the stock as well at the lower price. Okay, so what you're doing is you're insuring it. Because sure, I could buy the stock today at $24.75 with my 15% discount, maybe treat it as a covered call or treat it as nothing, and if it collapses and drops down to 22 in 10 days, I'm at a loss of $2. Here I'd still have a gain guaranteed of 125. Okay, so that's how I would structure it. If I have a gain in a stock, I bought a stock that has a gain in price, I'm going to go ahead and look for a position there to insure it. I'll go use the insurance tool, on power options to see which put options I can buy that will guarantee me a profit into the position. And then from there, we'll go ahead and try to lock in some of that profit and then treat it as a married put position with a guaranteed return on the position for an extended period of time. Okay. Jim says there's less premium for a stock trading in a tight range. Jim, you're right. But I have I probably bet that Glenn was looking for a trending stock because he's probably doing some kind of delta neutral or delta hedge strategy where it's not necessarily based on the premium, but it's based on rolling and adjusting the long and the short options to maximize the delta hedge, maybe even the Vega hedge as well, or the gamma hedge. Okay, sure. An investor might say, well, if you're doing covered calls, you should only find channeling stocks. In that case, Jim, I would agree with you. I don't want to do a covered call in a channeling stock. There's no premium. Why trade IBM as a covered call if I have to buy the stock at $130, $160, $180? I think it's almost $200 per share now, and sell an at-the-money 201 strike call for 40 cents. It gives me absolutely nothing. Okay, I have to go out 3 to 4 months to make the premium viable in that case. And that's not something I want to do. I want to see a little bit more movement. But as you all know, when I started trading covered calls, when I first started trading options 13 years ago, the risk reward didn't balance itself out. I got annoyed after 8 months of trading, then a year of trading, and then a total of 18 months of trading to see a covered call portfolio which required more management than the married puts, which we talked about at the beginning of the presentation, for a much less return. You know, at the end of that time period, factoring all the losses, the adjustments rolling up, rolling down, still getting assigned 65 to 70% of the time, I was only making about 2.3% gain in my portfolio after 18 months. To me, that wasn't getting ahead. It didn't suit my needs. I switched to standard collars at that time, and then about 6 years ago, I switched over to married puts after I met Kurt, and he showed me what he was doing, and I trade that in my account now as well. All right, ladies and gentlemen, what is 5:42 p.m. Eastern Time? If you have any last-minute questions, go ahead and send those in. I'll be happy to field one or two more. In the meantime, what I'm going to do here is just navigate back over to our slides here. Just want to remind everyone, if you haven't done so yet, make sure you register for that 14-day free trial. Just go to powerup.com and put in your name and email address and click Start My Trial. The subscription fee after the 14-day free trial, our 20-minute delayed service, is $60 per month. We do offer a real-time service. So every time you run a search or refresh the page, you're getting the numbers and the calculations at that very instant, and that's $100 per month. And then, of course, we also offer the historical suite of tools, the back testing tools for the given strategies on top of that, and it's just $40 more. So the 20-minute delayed service with historical is $100 per month, and then the real-time service with access to the historical tools is $140 per month. And of course, there's discounted rates available for the annual subscription. All right. Next week, next week, Kurt, of course, is going to have a RadioActive Trading presentation, I believe, on Tuesday and Thursday at 12 noon Eastern Time. We're probably going to have a tools discussion on Wednesday at 12 noon for the power options tools, likely related to the search and the analysis. And then Friday afternoon, of course, we'll be back with another open discussion, open forum Q&A session for you all. And you'll be able to register for those webinars at radioactivetrading.com or, of course, at powerup.com as well. Well, I don't see any last-minute questions. If you do think of something later on, please feel free to send me an email to support@powerup.com. Of course, you can also reach us during market hours at 302-992-7971. There's contact links on the bottom of every Power Options page. Thank you again for joining me this evening, ladies and gentlemen. I hope you got some useful information out of today's presentation. Have a fantastic weekend, and we will see you next week. Good night. Take care.